David, how the jobs number today fits into what you have been anticipating for the economy in the second quarter, and how that translates in turn into what the Fed's likely to be up to.
Well, it was a good report. It's nice to see over 300,000 jobs created. But remember, employment is a lagging economic indicator. And in this particular weird business cycle, it's going to lag even more because we have a huge number of job openings, and that is still causing employment growth to be strong, even though final demand is weakening here. The Atlanta Fed right now is running at a negative 1.9% for second quarter growth. Our numbers are stronger than that. We think we could still eke out a positive number. But overall, very little GDP growth in the first half of the year, lots of job growth. And what the Federal Reserve should recognize here is it's going to slow down. It will slow down later on this year. It's important not to be too aggressive right now because if you raise rates a lot right now, you could have a real problem at the end of the year and going into 2023.
Well, you say that's what the Fed should recognize. We obviously just heard from President Bostic. He's now at 75 basis points, it feels like, for a couple of weeks from now. That might be where the consensus is migrating. And it doesn't seem as if they're in the mode of trying to preemptively decelerate the tightening process here.
Yeah, I don't know what they've forgotten about basic macroeconomics here. Monetary policy, a lag. We are already seeing commodity prices peak. We've seen gasoline prices come down from over $5.72. We're seeing massive fiscal drag, the biggest fiscal drag since the end of World War II. We've got the dollar at its highest level since 2002. I mean, there's a lot of drag in this economy. It is going to slow down. Inflation is going to roll over, and they've got to keep their patience because if they're too aggressive right now, they will regret it later on. And the markets actually are pricing that in. They think the Fed will tighten too much and then have to ease next year. And I can understand why that's being priced into the markets.
Steve, speaking of things being priced into the markets, this week was kind of interesting leading up to today's report because we did see kind of at least glimmers of a renewed faith in treasuries as a potential safe haven. We saw oil tick down. It's up a little bit today. Is there a possibility that the market just does the Fed's work for it on inflation and we can look at this jobs report and say, you know what, maybe this is good news?
It is possible. The market has done an awful lot of heavy lifting for the Fed, but in order for the Fed to maintain its credibility, it has to come through at least with the bulk of the tightening that is out there in the market. You'll see that Bostic said 3%, and Bullard yesterday said 3.5%. So a half a point kind of separating the doves and the hawks right now. I think the Fed has an appointment with 3% it's going to make. And the question for the market, which I think is already being discounted, is whether or not it has to go further than 3.5% or 4%. And let me just say one other thing about the economy right now. We have so little visibility into the most important aspect of this economy right now, which is the service sector. You have this transition from goods into services, and we just do not have good data. I follow, David, you'd be happy to know, the J.P. Morgan credit card spending data, and it's showing pretty good spending when it comes to the service sector and not much decline when it comes to retail. This is daily 7-day average data. So I'm not necessarily seeing all of that weakness that some of the bears are picking up on.
Yeah, David, I mean, to that point, go ahead. Yeah.
Yeah, no, I think some of that, though, is a recovery in services spending as people finally go on the vacation that they've been itching for the last 2 years. So we are seeing a post-COVID surge in some service areas, which I would expect, and that will really show up in credit card data. But again, later on this year, I think particularly low and middle income households are getting squeezed by this fiscal drag. They are racking up their credit cards right now, but they're going to bump into the credit limits later on. So, I do think the economy is okay. I think this is, this labor market is acting as a cushion. So, and it does, the labor market does operate with a lag. And so there's sort of a lag on the sag in the economy, but I think it's still coming here. The Federal Reserve's got some interesting navigating to do here.